Welcome back, my name is Arya. I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're going to talk about Uber Technologies, which is in fact the ride-hailing service company that is behind the Uber ride-sharing app and additionally the Uber Eats app. So in today's video, we're going to go over the $32 billion disaster that Uber had, and additionally, we're going to go over and analyze Uber from both a qualitative and a quantitative perspective to try to see whether or not this company can outperform on a going forward basis. For starters, the $32 billion loss that Uber has is actually the amount of money that they've lost since inception, and they've been unprofitable for as long as anyone could really remember. Now, they didn't do this on accident. This is completely done on purpose, and this is to create what's called a network effect, which Uber has done successfully over the past decade and a half, but it costs them a lot of money to do. So they've built this network effect of having a lot of riders and having a lot of drivers on their app, right? At any time you could call a taxi up and they're able to come pick you up, whatever the case is, right? So the reason they did this is to create this massive network of users to be able to get to a point where they're at such a large scale that no competitor could meaningfully try to take market share away from them. And additionally, this falls in line with something that I listened to in this podcast. I'll link in the description. It's about Intuit. I recommend you watch it. But anyways, they talked about a quote from the Moody's CEO, Ray McDaniel, where he said he's in the standards business, where your last sale gives you the right for your next sale because of the network effect that you've built. So because everyone has used Uber and has been subsidized by very cheap rides over the past decade and a half, this allows for Uber to have such a large mind share among all the different consumers that they've taken rides with them in the past. So the next time you're in need of a taxi or whatever, your mind immediately goes to, oh, let me call an Uber because it's so convenient, it's so easy. I've been using it for years now. I've called multiple Ubers in the past, right? And that doesn't really leave much room for other competitors. Additionally, on top of that, the simple fact that Uber has become like a verbiage of pop culture of, oh, let me just call an Uber. Oh, just call an Uber, right? It kind of builds like a language moat in that sense as well. Like we've seen similar language moats with Google actually. Now, jumping over to the fundamentals, Uber has in fact actually become profitable and very profitable at that. But to kind of set the stage before we dive into the profitability aspect of things, I want to just kind of give you an idea of how Uber actually makes their money. So obviously we know they got the Uber Eats app, and additionally they got the ride-hailing app, just the normal Uber app, and that's categorized as mobility revenue and delivery revenue. So mobility revenue in the pink here, this is actually the ride-hailing service, roughly $20 billion of just under $40 billion of revenue total, which that's incredible in of itself. So roughly half of the revenue is made from the ride-hailing service, and then they have roughly $12 billion of revenue from delivery, so your Uber Eats app, that stands at just under 33% of total revenues. But you might notice there's a red bar here as well, the freight revenue. Now I had to actually Google this because I didn't know what it was, but Uber Freight line is not actually like them delivering groceries or whatever. That gets grouped into Uber Eats. It's actually like supply chain deliveries. So Uber actually delivers a bunch of just groceries to grocery chains or McDonald's foods or whatever to various different McDonald's locations and all that type of stuff. That's all done through Uber. So Uber partners up with all these enterprise customers and actually delivers their foods to them and all that type of stuff, which very interesting business line. And you can see that it has grown incredibly over the past 4 or 5-ish years, going from $300 million in revenue to $5 billion. So out of nowhere, they've kind of just propped up this revenue line. Additionally, one thing I want to mention that doesn't really show up here, I don't know where it would be, the ads business that Google has built. And this is something that I always thought about just because I was thinking of Amazon and how they have an ads business of when you search about iPhone charger, the first 4 results show up people that have paid ads to be on top there. Why wouldn't Uber do the same thing? When you search up Mexican, it should be Mexican food that shows up there that they paid ads to be at the top, right? So I always thought about that, and Uber has actually implemented that in the past 2 years, and they've done incredibly well. So that's a very high margin part of the business. And I think that actually speaks to the profitability and the levers of monetization that Uber has been able to pull on in the past, call it 2-3 years. So I think that kind of speaks to Uber having this massive install base and being able to monetize them over time. It should be interesting going forward. Now, revenue is great, but how profitable are you? And to answer that, I'm not going to actually dive into the numbers right away, but I want to show you guys how Uber actually became profitable. Now, this is a video by More Perfect Union. I'm going to link it in the description if you want to watch the whole thing. I highly recommend it. I'm just going to play the clip and then we'll talk about it after.
Way more than inflation. Fares are up 65% since Uber went public. But proving that Uber was paying drivers less was tricky because management hardly gave clear answers. According to Sherman's analysis, at the start of 2022, the average fare was about $21, with the driver earning a little over $13. That means that Uber took home the remaining amount, or 35%. By 2023, the average fare was up to over $21, but drivers, they were making less. Uber's take increased to over 40%. How did they pull it off? Well, technology. Historically, drivers were paid based off of trip distance and duration. With this, Uber flipped the script with something they called upfront fares plus destination. This new system uses a complex secret algorithm that weighs a bunch of different factors to set prices. On the upside, drivers can now see their pay and destination before accepting a ride. On the downside, there's a growing concern that Uber might be pushing drivers into a corner, offering drivers who skip the less lucrative fares fewer rides, which creates a race to the bottom.
So as you can see, they've actually increased their take rate with drivers. So initially, maybe when they first started out like 10, 15 years ago, or whatever the case was, they're actually taking roughly 35% of the total trip cost. But as time has went on, they've actually increased that take rate against drivers. And this is actually what has driven many drivers to strike out against Uber and go pro-union or whatever that's called, right? I highly recommend you watch the video because they actually go very in-depth into all that type of stuff if you want the details on that. So as you can see, the record amounts of free cash flow that Uber has been able to produce is actually a result of them increasing their take rate in addition to cutting costs and all that type of stuff. Long term, this probably increases a little bit added risk of how are they managing the relationship between their drivers and their riders and increasing prices and not turning away the consumers and all that type of stuff, right? But as you can see from a shareholder perspective, this is just absolutely brilliant. I mean, they have record amounts of free cash flow. And if we actually stretch this out, we could see that analysts are expecting over the coming years, you could see that it's going to double in the next like 3 years, right? That's a compound annual growth rate of like 30%. Just from a shareholder perspective, this is absolutely amazing. From a pro-union, pro-labor type of perspective, not necessarily the greatest of things, but you could see a very clear trend, free cash flow flipping from 2019 all the way to 2026, it's flipping from super in the negative to very, very positive. And additionally, even when you factor in stock-based compensation, and especially when you look in the past like 2 years or so, you could see that stock-based compensation hasn't moved meaningfully. It hasn't grown much. But on the other hand, free cash flow has just absolutely exploded upwards. And this really does speak to the new age that we are coming within technology industry as a whole, whereby companies are way more caring of actually how much stock-based compensation they're issuing, and shareholders additionally are waking up to the fact that they're getting diluted on the claim they have on those free cash flows. Jumping over to Morningstar to look at some of the risk factors and additionally the economic moat of the company, Morningstar actually assigns it a narrow moat, which I kind of disagree with. I think the scale at which Uber operates in, and additionally the network effect that they've built up over the years, that definitely warrants a very wide moat. I don't think you could just spin up an Uber. So they say, in our view, Uber Technologies' core business, the ride-sharing platform, benefit from network effects and valuable intangible assets in the form of user data. A ton of data on these users. You can actually provide a better algorithm and all that type of stuff, right? So I think that does speak to the moat. Additionally, they got, of course, the brand, which I think the brand in of itself is absolutely incredible as well. Jumping a little bit down here, they actually mention some risks to the business. They say, while Uber has benefited nicely from the network effects, we don't believe it benefits from customer switching costs. In our view, the ride-sharing industry lacks barriers to entry or exit for customers and drivers. Both customers and drivers can easily switch to Lyft or other competing platforms, while customers also have other transportation options like taxis and public transit. In general, just as firms with network effects benefit from the positive flywheel effect, they also run the risk of negative flywheel if customers, drivers, or both start to depart, especially when the network lacks meaningful switching costs. And this is the key line at the end of it right here. Networks in tech are strong when faring well, but can unwind quickly. Think of MySpace, right? So they even give you the example right there. This is absolutely true. So there's very little differentiation between Uber and Lyft. The only main thing that I could think of is actually the brand. And I think it has an incredible brand. Every time you think of calling a ride-hailing service, you're thinking Uber. Oh, just call an Uber, right? Like it's kind of become verbiage in the mind of everyone. And earlier in the episode, we actually talked about the Moody CEO talking about how it's a standards business. I think this absolutely applies to Uber as well. When you think of getting a taxi, you think of getting an Uber. It's completely replaced that, right? Same way that Google maybe 20 years ago started becoming a verbiage in of themselves and, oh, just Google it. That's become a verbiage of everyone's everyday life, right? So I think Uber is also kind of taking that mind share, and it becomes an incredibly powerful tool when you benefit from something like that. It's a very envious position that these businesses are in. Everybody is consistently thinking of your service and aligning that with the category that you're in. Very envious position to be in. Moving on, at last, I want to jump over to the growth to free cash flow calculator that I include in every single one of my videos. Long story short, we're taking the current valuation of the company and we're dividing it by how fast we expect the company to grow at. So if we jump over to Uber over here, we could see that I've inputted the numbers in. These are, of course, forward numbers. So I'm expecting roughly $5 billion of forward free cash flow. And I put 20% But might I remind you that revenues are actually growing by roughly 30%, right? And they're expected to grow by roughly 30% over the next 3 years or so. I tend to agree with that just because of the total addressable market that Uber has built for themselves. So actually choosing 20% on a spreadsheet here is extremely conservative. You can see that if I bump this up to a 30% growth rate, and I'm assuming it's 1-to-1 with free cash flow, we can see that that immediately jumps to 1.42. That puts it at a bargain price right next to Salesforce, which is a company that I've been buying heavily in the past couple weeks. And on top of that, I'm not taking into consideration the fact that Uber has been expanding margins over the past couple of years. That is another growth vector that they could tap on, try to bring in more free cash flows over the coming years. So if you have revenues growing at 30% and then your free cash flow margins, which is roughly 11%, in roughly 3 years, it's expected to be roughly in the 16-17%. That means that your free cash flow growth rate is actually just a little bit faster than your revenue growth. Again, I put 20% here, but I'm leaving an incredible amount of margin of safety in this calculation just because I think Uber is a little bit more of an uncertain industry, and especially because it's a relatively new industry, I think there's a lot more risks that we have to discount in our analysis over here. Nonetheless, it doesn't trade at too bad of a price, and I'm actually very interested in perhaps adding this to the portfolio. As you guys know, I call my portfolio the scale economies portfolio, and this fits in perfectly. So this is a company that I'm actually in the research phase as it stands currently. I still need to assess some of the risks and all that type of stuff before I make a purchase decision, but I'm curious to know what you guys have to say about the company. And with that in mind, I'd like to ask you to do something that costs you nothing. If you could hit the subscribe button, I'm going to continue to post high quality videos just like this one, and you could always go back on that decision if you end up not liking the videos. Thank you for watching. Have a great day.